We now turn our attention to Mr. Price. And Chris, I'd like to start with you, specifically around the issue of the imminent replacement of STC with a dividend withholding tax effective on the 1st of April 2012. Now, they declared an interim dividend of 93 cents per share, which represents a 22% increase from the comparable period in their latest results. What do you anticipate this new tax to be on companies like Mr. Price, which are fairly good dividend payers?
Yeah, I'm not sure if there's going to be an enormous difference, because effectively it just is shifting where the tax gets paid, but I think it's pretty neutral in terms of the actual overall tax, the tax bill. They might find, you know, a great incentive to pay dividends, but you know, I wouldn't worry too much about that as an impact. I'm not anticipating a big impact in that move. To me, it was, you know, why even bother? But they are, and we're getting that new withholding tax instead of the STC. Nevertheless, it was a nice increase in dividend, and dividends are actually quite an important source of return. And will becoming increasingly important source of return going forward. It's certainly one of what we call our three major investment criteria: yield, growth, and solvency. Some people use quality instead, but with Europe, it's a solvency problem more than anything else. So yield, growth, and solvency are your three big investment criteria, and I think Mr. Price in a way fits this. Valuation, though, is a little rich on that, as it is against this whole sector in a sense. So this may well be a case of an outstanding company with excellent management. It's redoing its brand, and it's really looking great, rejuvenated, and that. But we also need to say, if it's a bit rich, it might not necessarily be a good investment. Right. And that's the distinction we have to try and distill now.
Craig, let's come to you in Cape Town. They're looking to open their first test store in Nigeria in March 2012, and this is the furthest away from their home market. But they're also battling to secure properties there. What do you make of this move to Nigeria, and do you anticipate that Mr. Price will be a success in Lagos?
Well, look, they cannot not move into the African continent. All the other retailers are doing it. The difference is Truworths are doing it on a franchise model. They're doing it as a corporate-owned store. And of course, they've targeted Nigeria as one of the growth areas. Angola, funny enough, one where a lot of the other entrants haven't gone into. But I do think that it's something that has to happen, because we're reaching a bit of maturity in the retail space. In fact, you look at the number of stores that they opened, I think it was one up, if you had the net figure in terms of closing and opening. So part of that has been improving the trading densities and looking at increasing profitability per store. But some of the effects on that has been as well as an increase in inventory. We've seen that in the balance sheet. It's gone up quite considerably, and stock turn in certain of the chain stores has increased, particularly like Sheet Street has increased significantly. So those are a little bit of worrying factors as part of the strategy, but we understand why it had to happen.
In the interim results, they reported sales growth of 14.3%, Chris, but according to Stats SA, the retail sector only averaged 7.5% growth. How do we justify Mr. Price's outperformance of the retail sector? Well,
I think Mr. Price is in an outstanding space. We often focus on what we call the emerging middle class. But I think what's missed is that we often do it because of glamour issues and that kind of thing. I think the most important market segment, not only in South Africa but Africa, is the emerging working class, where you've got an improvement of wages to a point where people can make different decisions. And this has a much stronger brand than, say, Pep or some of the other lower cost brands. This is a store that the middle class can shop in, but also the working class, as it were, can also shop in. And that's where the uniqueness of it and the new brand or the brand image that they're bringing out at the moment, that they're revamping their stores with, is really superb.
I'm sure you also like the fact that the company is hugely cash generative too, Chris. Are you going to give it a hot vote, Mr. Price, yes or no?
I'm still going to go with hot with this one, even though I'm wary that the valuations are quite rich. I suspect that the move into Africa is also going to be, is fraught with risk, and there's all sorts of potholes, but I think they're just in the right space, that it may take off a lot stronger than what is factored in the share price.
Thank you, Chris. Craig, let's get your vote. Chris saying that it is hot, although the valuations are a bit rich. How do you feel about Mr. Price, and also the fact that they now want to go into online shopping? Is there even a big enough market to substantiate something like this? Hot or not for you, Chris? Craig. Craig.
Look, I think the story's hot. Why I like them as a clothing retailer is because of that cash side. Only 80–90% sold on credit, although that also increased quite nicely. But I think that makes it slightly defensive, because I also have a view that most of the apparel and clothing retailers are on the high side, but amongst them it's probably hot.
It's probably hot, and something else that's hot for you is your stock pick for today. Craig, you've gone with Naspers. Tell us why you've chosen the stock.
Well, look, it's a very diversified media player. Most of the media companies have gone under a bit of pressure, but of course, Naspers has tackled some of the new technology. We often talk about Tencent, and the share price has come off a little bit in terms of that growth subsiding a little bit in China, but there's still a lot more growth to come there, as well as a lot of the other internet companies. But even the multi-choice and the DSTV side of the story, you can see some of the innovations that have happened in the last 18 months, and that's going to translate into good earnings. So from a long-term perspective, I think at about 340 or thereabout, it's still value in the stock.
And you liking the operations in Russia with Mail.ru? What do you make of their performance?
Yeah, of course, that also was underperforming in terms of what analysts expected. But if you look at the history of the growth that's come out of there, there's still growth to come, and it's been an excellent investment for them.
Excellent investment, says Craig. Chris, you have gone with Impala. Tell us why you've chosen this as your stock pick for today.
The platinum price has lagged the gold price, as everybody knows. I'm a notorious gold bull, as it were. But this is a nice possibility if you're going to see a catch-up. If you have a look at what central banks are doing, they're actually going for growth. They're not worried about inflation as such at this stage. You've got synchronized easing that's taking place, and I think that's going to be good for platinum. This COP17, we need to appreciate that platinum is what I call as a green metal, because it's very strongly linked to pollution control as well. And I think platinum demand is going to continue to rise, both on the industrial side because of the need to clean pollution, but also, it's got a myriad of other uses, but also on the investment side, I think is also going to rise.
Could you just expand on what you said about how it's really a green metal, and that it's in light of COP17?
In all your exhaust pipes, to meet emission standards, you've got to have a platinum catalytic exhaust. That is with emissions being tightened up, etc., and the need to even do it on a much larger scale, for instance, it's possible that platinum in far greater quantities will actually be needed to try and clean the big polluters, so not only in cars but also in these big smokestack industries may have to start employing technology which would invariably need platinum to actually to cut back emissions.